You have $1 million, not in cash, in buying power, and you have two doors in front of you. Behind the first is a small business worth $1 million. Behind the second is $1 million of real estate. Same starting value, same you. Two completely different lives. For the next 10 years, we're going to let both versions of you make the same decision. Buy the asset, keep it. Reinvest what it produces. And then see who ends up richer. At first, real estate looks almost unfair. The building is tangible. The rent arrives. The bank understands it. The business? It has employees, customers, competitors, and 100 ways to ruin your Monday. But 10 years from now, one version of you may own a stable portfolio worth millions. The other may own something worth far more, or nothing at all. Because the real difference isn't which asset makes more money. It's what each one demands from you to get there. On the left, you buy the property, a $1 million building. You put in your capital, use financing for the rest, and tenants begin paying rent. On the right, you buy the business. Also worth $1 million, it already has customers, employees, revenue, a manager who promises everything runs smoothly. For about 3 days, both decisions feel brilliant. Then reality arrives. At the property, a tenant reports a leak. Annoying. You call someone. It gets fixed. At the business, your best employee walks into your office and resigns. Now the problem has a face and a deadline. By the end of the first month, you understand the first difference. Real estate mostly asks you to protect an asset. A business asks you to improve one. From the outside, the property version of you looks boring. Rent comes in, mortgage goes out, insurance, maintenance, taxes. Whatever is left is yours. The business version looks more exciting, more revenue, more movement, more people, also more ways to get punched in the face before lunch. One customer represents 10% of sales. A competitor cuts prices. Payroll is due Friday whether customers pay you or not. Yet the business has something the building does not. You can change it. You can raise prices, improve sales, launch a new service, hire a better manager, open another location. The property can improve too, but its economics are tied much more closely to rent, financing, occupancy, location, and the market around it. The business gives you more levers, which sounds great, until you realize every lever can also be pulled the wrong way. 1 year passes. The property has done exactly what you hoped. Most units stayed occupied, rent covered the bills, you made some cash. Nothing dramatic happened, and that is the point. On the business side, nothing was calm. You replaced the employee who quit. You lost a customer. You won 2 larger ones. You discovered one product barely made money, so you killed it. You raised prices on another. Revenue grew, profit grew faster. At the end of year 1, the property owner has something valuable, predictability. The business owner has something different, momentum. And now both versions of you make the same decision. You don't spend the extra cash, you reinvest it. The real estate version uses saved cash and growing equity to work toward another property. Now there are 2 rent checks, 2 mortgages, 2 roofs that can leak, but also 2 assets quietly being paid down over time. The business version reinvests differently. A better salesperson, new equipment, marketing that actually works, a manager who removes you from the daily chaos. Then something important happens. Profit rises without your hours rising with it. That changes the value of the company, because a business that produces more reliable profit can become worth more, even if the building it operates from hasn't changed at all. 3 years in, the 2 paths begin to separate. The real estate portfolio is becoming stronger because you own more property and owe less against it. The business is becoming stronger because the machine itself produces more. One path compounds through assets, rent, debt paydown, and appreciation. The other compounds through earnings, reinvestment, and the multiple someone may eventually pay for those earnings. By year 5, the property side feels almost comfortable. You've learned what breaks. You know what vacancies cost. You keep reserves because the universe has a sense of humor, and roofs apparently know when your bank account looks healthy. Your portfolio is larger now. Rent has increased. Debt has fallen. The equity number on paper looks good. Then you look at the business. It has changed more dramatically. The company no longer depends on you every day. Management runs operations. Sales are higher. Profit is meaningfully higher than when you bought it. And now someone makes an offer to buy the company, not for what you paid, for what it earns today. This is the moment the comparison gets uncomfortable. Real estate rewarded you for owning a good asset for 5 years. The business may reward you for turning a good asset into a better one. But there is a catch. The property did not need you to reinvent it. The business did. Then year 6 arrives. And both versions of you get hit. On the real estate side, one large tenant leaves. A major repair lands in the same month. Cash flow turns ugly. But the building is still there. The location is still there. You cut distributions, use reserves, find a new tenant, and wait. On the business side, your biggest customer leaves. Then a key manager follows. Sales fall, profit falls faster, and suddenly, the valuation you were so proud of looks very different. This is where the business reveals its ugly side. A building can have a terrible year and still be a building. A business can have a terrible year and become a much worse business. Your upside was more controllable. So is your downside. You cut costs. You personally step back into operations. You rebuild the sales pipeline. For months, the business owns your life again. The property version of you is frustrated. The business version is exhausted. Both survive, but only one had a realistic chance of becoming nearly worthless if the recovery failed. 10 years after the first purchase, we freeze both lives. Same person, same starting opportunity, very different decade. On the real estate side, you now own a small portfolio. Rents have grown, loans have been paid down, some properties appreciated. Your equity is several times larger than when you started. Cash flow is meaningful. And if you hired good property management, your life is relatively predictable. On the business side, the company recovered. Then it grew again. You built management around it. You reinvested heavily. Maybe you even used its cash flow to buy a smaller competitor. Now the company produces several times the profit it produced when you bought it. And because businesses are often valued as a multiple of earnings, that growth can create a much larger jump in equity value. The business path wins on one thing very clearly: potential. The real estate path wins on something equally important: forgiveness. So which one actually made you richer? Let's use a simplified example, not a promise. Suppose the $1 million property was bought with 30% equity. Over 10 years, rents rise, the loan balance falls, and the property appreciates. Through reinvestment, you add more property along the way. Your original capital could grow into several $1 million of real estate equity. Now take the $1 million business. Suppose you also finance part of the purchase. When you buy it, it produces around $200,000 of annual owner earnings. Over 10 years, you improve the company until earnings reach $600,000. If a buyer values that business at roughly 5 times those earnings, the company could be worth around $3 million. If you used excess cash to reduce acquisition debt or buy another small company, your equity could be higher. But notice what just happened. The business did not win because businesses magically outperform property. It won in this scenario because you increased the earnings. If profits had fallen instead, the result could have been brutal. Real estate gives you fewer ways to create explosive value. It also gives you fewer ways to accidentally destroy it. The exact winner changes with leverage, taxes, interest rates, rent growth, business margins, purchase price, valuation multiples, and how well you operate. So there is no honest universal answer that says one always wins. But there is an answer to a better question. Which one is more powerful for you? If you want an asset that can compound while demanding less creativity from you, real estate is difficult to beat. You still have vacancies, repairs, financing, bad deals, and bad markets. But a good building in a good location can remain useful even when you make a few mediocre decisions. A business is less forgiving. Customers can leave, employees can leave, margins can disappear, technology can change the market, your own decisions can destroy value quickly. But that same flexibility creates the upside. You can improve pricing, sales, operations, management, products, locations, acquisitions, you can change the machine. So if both versions of you start with the same buying power, real estate may give you the smoother path. The business gives you the wider path, wider upside, wider downside. And 10 years later, the biggest difference may not be the number in your account. It may be who you had to become to earn it. One version of you became an investor. The other became an owner and operator, then learned how to stop operating. Both can make you wealthy, but if you can actually build, improve, and eventually remove yourself from a great business, the ceiling can be much higher. If you can't, that $1 million business may become the most expensive job you ever bought.